5 years ago, retail investors betting on GameStop were derided as dumb money. The events were synonymous with stock market gambling. Consensus on Wall Street was that most individual traders would retreat after COVID, but those assumptions have been proved wrong. Average investors are now outperforming the market and becoming much more influential than many predicted. Professional traders have been forced to pay close attention to retail traders who are now influencing market structure and fueling the rise of new asset classes.
Look at how retail is perceived now. They're a dominant force in the industry.
They're actually very savvy. They bailed out the market during COVID and they bailed it out again during the tariffs. Like they were aggressive buyers.
Here's how retail investors went from a market sideshow to a force Wall Street can no longer ignore. GameStop was a truly unique event in Wall Street history. It brought an unprecedented level of attention and volatility to the stock market. Millions of people rushed to get a piece of the action with GameStop shares and options, which pushed the stock up by 1,600% that first month of 2021. The market movement crushed some hedge funds, and as the price jumped, short sellers then had to buy back the stock to cover those losses, which created what's known as a short squeeze.
Institutions became afraid of retail during GameStop for good reason. You know, there's strong power in numbers in retail. That kind of opened all the institutions' eyes as to the importance of retail.
While GameStop certainly poured fuel on this trading boom, there were some structural changes that had paved the road for this trading frenzy. Just 2 years earlier, the entire industry had dropped commissions to zero, pioneered by Robinhood, making trading essentially free. A few decades ago, think about commissions, they were closer to $100. By 2020, most brokerage firms had added the ability to trade fractions of a share. That meant you could buy in dollar amounts versus needing to have thousands of dollars to get access to your favorite tech stock. And there were largely no account minimums.
It's really kind of opening the door and getting rid of all the barriers for basically anybody.
On an average day, retail investors are now making about 20% of daily market volume. Flashback to before COVID, that was in the low single digits, according to BlackRock.
People had an assumption that once COVID cleared up and, everybody went back to their daily lives in whatever form that is, that this retail participation would subside and go back down. And, everybody would say, oh, you go manage my money. What maybe has surprised me a little bit is how strongly it's continued. Because 10 years ago, you had periods where the equity participation by retail customers was maybe 10%. Now you can see instances where it's 40%.
Retail investors have now diversified well beyond meme stocks.
Many people, for the first time in their lives, took an interest in the market and took an interest in the different tools in the market. And I don't want to downplay that people did lose money, but what it did also lead people to is to get educated and to understand how the market can use to create wealth.
Retail investors first changed their strategies as interest rates shot up and dragged down shares of widely held tech companies. They flocked to interest-bearing products, and they have been powering the stock market in some of the downturns we've seen with outsized appetites to buy into sell-offs.
That, dumb money moniker, you don't hear it so much anymore because the professionals have certainly learned a lesson from the tenaciousness of the retail investors who believe in companies that are good companies and continue to buy them. We graduated to Meta, Apple, any of the Mag 7. And when they start to suffer, you often see the retail investor be the first one to lead the charge.
They're 29 years old. So if it keeps going down, they'll buy more. They know that over the course of the next 40 years, there's probably going to be an average of 9 to 10% return. And they might have 5 years where they don't get it, but in the long run, they're going to get it.
The Magnificent Seven stocks have also helped drive retail portfolios and help them beat the market. Palantir is a widely held name. It drove outperformance last year. Same with Nvidia. They've also been rushing into commodities lately, especially gold and silver, where inflows hit new records this year.
I think the post-2020 world looks a lot like it did in the 90s to me, which is that retail investors actually are really good at fleshing out good growth stories, and then they can do it with size and conviction, and they are difference makers, and we've seen it today. In the meme stock world or the post-GameStop world, a lot of ideas are socialized on either Reddit or X. A lot of our institutional investors now follow Twitter and Reddit closely. And they're employing AI agents to monitor activity and conversations.
Wall Street is paying attention and starting to tailor offerings to this group of active traders. They've been rushing to offer more access to cryptocurrencies and crypto ETFs. Prediction markets are booming, and brokerage firms are now rushing to offer 24-hour trading, a structure made popular by cryptocurrency markets, which trade overnight and on the weekends. There has been a boom in private market offerings for average investors to get a slice of this AI boom in Silicon Valley. And there have been worries, though, about the staying power of this group. It's all great in a bull market, but what does it mean in a prolonged downturn?
We will at some point have a down move. That will discourage some people. But I don't think it's going to discourage as many people as it has in the past. Downward moves make people more cautious. They lose money. They don't have the discretionary brokerage account that they did at one time. It will happen, but after a year or two, those things start to settle down and people go back to things they were doing before.
More sophisticated and riskier products like options and leveraged ETFs have also become a lot more widely available. These instruments provide more risk, but also outsized returns in some cases. They also offer the ability to add more downside protection.
A lot of derivative products, whether it's short-dated calls or call spreads or call put spreads, which were only used by institutions, are now available for retail investors. And in some ways, that is a tool, but it does require skilled driving. I mean, it's like today, almost anyone can now drive a Ferrari of financial markets. And so it can be quite dangerous, but of course, in the right hands, it can amplify returns.
Wall Street also has a multi-trillion-dollar reason to pay attention. Younger retail investors are set to inherit record wealth passed down from baby boomers to millennials and Gen Z.
About 120 trillion in the next 20 years will be inherited to the millennials and Gen Z. That's 4 times the size of the U.S. economy.